Okay, welcome, ladies and gentlemen, to the Frontiers in Quantitative Finance seminar. This seminar is brought to you by the Oxford Mathematical and Computational Finance Group. And on behalf of my colleagues from Oxford, we're very pleased to welcome you here. And the seminar is supported by the Citigroup, who provides this nice venue, and Mosaic Smart Data provides financial support for the seminar. So today we're very happy to have Professor Olivier Gueant as our speaker. Olivier is well known to many of you, especially those who are interested in market microstructure and optimal execution. He has a lot of research work in this area and a very nice book. Olivier started his career with a PhD in applied mathematics with the fields medalist Pierre-Louis Lyons as his advisor. I believe his PhD was the first on the application of mean field games to economics and finance. That was the goal, I guess. So that was the early days where Pierre-Louis Lyons had developed this theory of mean field games, and he tasked Olivier with finding applications to economics. I think you tried to apply this to oil markets or something like that, right? Okay, very tough topic. And you know, some people like Lyons have very strong scientific personalities, and once you get into their orbit, you can hardly get out. But interestingly, Olivier did not stay in the orbit. He developed a very original style in his research, and he did not continue doing the same thing, mean field games, all his life, but he did many very different things in quantitative finance, including things he's going to talk about today, optimal liquidity provision, and he's been working on topics related to decentralized finance in the recent years. So I leave the floor to Olivier, who will talk about his recent work on optimal liquidity provision in currency markets from FX to crypto markets. Thank you.
Thank you very much. So today we are going to orbit around the optimal liquidity provision. No mean field game. I swear there will be no mean field games. And I want to talk about the traditional FX and cryptocurrency markets, as you said, and as it's written in the title. Basically, it's a summary of, I think, 4 papers that you can find on the web. So I don't focus on the papers, but I want to tell you a story and to show the different points regarding traditional FX and crypto markets. So a short introduction to market making first. Market makers. The market makers are people, or nowadays algorithm, providing bid and offer prices to other market participants, and they make money out of capturing part of the bid-ask spread. And of course, because they buy and sell, they hold inventory and face the risk that the price moves. And if they are long, and if the price goes down, they lose money, and symmetrically. So basically, the risk is that the price moves adversely without them being able to unwind their position. If you want to know more about market making, I do a bit of self-advertising, but as you can see, the book on the right, the book of Alvaro, is slightly larger, so maybe it's because it has a far better title, I think. And so you have 2 books and maybe more today, but these books are about optimal execution and market making. And if you want to work in this field, you'd better download the books or buy the books on your favorite platform. So the basic modeling framework for market making. You have a reference price. It's a mid price. It can be, if you know corporate bonds, it can be the CBBT of Bloomberg or the CP Plus of Market Access. It's a reference price of that bond that you have at some point in time, okay? Or for FX, for instance, it can be the mid price on some liquid platforms like EBS or Refinitiv. So you need a reference price. And then the market maker is going to propose a price at the bid. So I'm considering something quite simple. Proposing a price at the bid with a delta, so here ST minus delta TB, and at the ask, ST plus delta TA. And of course, the market maker is going to choose delta TB and delta TA. And depending on the choice of delta TB and delta TA, there will be like a lot of trading flow, or high trading flow or low trading flow, and you will have an inventory moving up when you sell and when you buy, and moving down when you sell. And of course, the probability to buy depends on deltas and on delta B, and the probability to sell depends on delta A. Okay, if you propose a good price to clients, there will be a lot of clients coming. If you propose bad price to clients, there will be nobody coming, basically. Okay, so this is summarized in the form of an intensity. Okay, the intensity of the process NB and NA, modeling the number of trades, okay, decreases with delta. The further you are from the price, the lower trading flow. Okay, so everything makes sense here. And of course, when you buy, you spend money. When you sell, you make money. Okay, so it's an exchange from left pocket to right pocket. Left pocket, you have assets. I mean, here, whatever is the asset here, and on the right, in the right pocket, you have cash. So but of course, you have spread capture when you write the P&L. So the P&L is the cash plus the mark-to-market value of your portfolio, okay, of your assets, and it's the P&L at the beginning plus the spread you capture of the trades, okay, but plus some risk, okay, inventory risk. If QT is equal to 0, you have no risk, you're flat. If QT is positive, then of course you're afraid of the price going down, okay, and this is the term in DW here. Okay, so that's the setup. And if you look at the literature, there are two objective functions. One says, let's take the expected utility of the P&L, where the utility is exponential. That's Avland and Stoikov. And there is something preferred by practitioners, which is saying P&L minus some proxy of the variance. In fact, it's the quadratic variation. Okay, and in that case, you maximize this. So P&L minus a penalty, just to say you don't want to hold inventory, and all the more, and this effect is increasing with volatility. If volatility is high, you really don't want to hold inventory. Okay, so that's a problem of control. That's an optimal control problem. In that case, it's optimal control problem on the graph. But if you know optimal control, you can use all the tools. You have Hamilton-Jacobi equation. The equation looks like this. So in fact, it's a system of ODEs. It's not a PDE in that case, because I took constant sizes. Okay, so system of ODEs, quite nice, where the function h has some, it's like a Legendre transform. It's not exactly a Legendre transform, but it can be modified to be a Legendre transform. Okay, so that's the setup, classic optimal control setup. And well, it's a remark, but if you use model A, which is the model where you use an expected utility, then in that case, you obtain almost exactly the same equations. And as I said, you have a system of ODEs, nonlinear ODEs. And if you want to obtain mathematical results, it's really not complicated. You simply have natural assumptions plus a technical assumption here, this one here, the last on the slide, okay, which is satisfied by exponential, logistic, all the natural intensities you can imagine, and it's really something that makes sense if you. There is a deep reason why this. I won't detail, but there is a deep reason why this has to be satisfied. When you solve the equation, I go fast on this because it's just a principle of all the models. Once you solve for the value function, you can have the optimal quotes, okay, as a function of all the parameters. This is not complicated, and basically, if you look at this model, it's easy to obtain numerically an approximation of theta using an implicit scheme, and then you have standard techniques. Everything is in papers, everything is documented. You can have the optimal quotes at the bid, and at the ask in this models. Now that's the general stuff. But what about, I said FX and I said cryptos? What is that specific to FX or that specific to crypto? Well, first, this is a description of the FX market that you can find in a paper by Schrempf and Sushko. I think they're working at the BIS, the Bank for International Settlement, and you see here that the FX market is decomposed into a D2C segment, okay, where clients are connected to the stream of dealers, okay, so that's really OTC, and an interdealer, so ID, interdealer broker market, or D2D, dealer-to-dealer market, where a dealer can trade with a dealer. So dealer trade with clients, okay, but if they only do that, they are waiting for clients to trade with them in some sense, but they can also be active in some sense because they can trade with other dealers. So that's two mechanisms. You have RFS, request for stream, or request for quotes on the D2C segment, and you have access to multiple platforms on the D2D segment, or sometimes on platform where everybody can trade. But the thing is, dealers, they can internalize the flow, okay, and wait for clients to come, or they can externalize the flow and say, I'm too long, I want to sell, okay? And of course, in that case, they need to cross the spread or go into a dark pool to cross half of the spread, but they need to do, they are active in that case, okay? So we need to model this. I give you some other figures here, still from the same paper. If you look at the one in the middle, the internalization ratio is variable, but say it's between 40 and 80%. Okay, so really only modeling internalization, assuming it's 100%, is wrong. Okay, and so we need to model externalization. Also, an interesting figure on the right is the algorithmic versus manual trading on EBS, and you see it's well, that's a trend. Algorithmic trading is quite huge.
So what is the extent?
Here? Yeah. Yes.
Okay.
Yeah. So the point is the internalization. Yes, you're right. It's not obvious without the 2000. So the internalization versus externalization dilemma has to be taken into account if we want to build an efficient algorithm. It has to be taken into account. Also, something specific, not specific to FX, but something that exists in FX and in other OTC markets, the ID of clients is known, okay? So if you send me a request, or if you are connected to my stream, okay, I know who you are and I know who you are. So maybe I will not propose the same price, okay? That's called price discrimination. It's not bad. It's just a way to do risk management, to propose different prices to different people based on their alpha, based on their, I mean, you have plenty of reasons to do that, okay? And not bad reasons. I mean, when people hear discrimination, they think it's bad, but it's not only bad, okay? There are good reasons to do that. And of course, sizes are not constant, and dealer usually propose a price letter. They propose a price for 1 million, 2 million, 5 million, 10 million, and then we do a VWAP between the prices to have the price for 3 million and I don't know, and 1,000. Well, I mean, whatever, any figure. Okay. So if I look at the equations with internalization, here I have the price, so I still assume it moves like a Brownian motion. Okay. There is just one asset in this model, and every time, so the clients are tiered into n tiers. Okay, and every time there is a trade with a client, well, if there is a buy, it increases my inventory, and if there is a sell, it decreases my inventory. Okay, here is just I have some Poisson measures. It's technical, but it's not really important. It's just a client flow from each tier. Okay, and then, well, every time I have a trade, either I pay or I receive money, I receive cash. So I have the associated equation in terms of cash. That's exactly the generalization of what we did before. There is nothing like externalization here. Okay, I'm still waiting for clients to trade with me. I'm passive in some sense. I'm not passive because I can skew my quotes. Okay, I can decide on the deltas. I can decide if I trade at a low price, if I buy at a low price, okay, or to deter that kind of flow, or if I want to buy at a very high price, okay, to attract sellers. So I'm active in that sense, but I'm passive in the sense that I still wait for the flow to come to me. If you think of externalization, it means that I can also trade on the market. And basically, it means that I'm doing optimal execution in some sense. So I can add in blue here the classical terms of angle increase, saying, well, if we do angle increase in continuous time, so optimal execution, it's my inventory evolves in not absolutely continuous way, but I have a VT here. I can buy or sell. I decide whether I buy or sell, but when I buy or when I sell, I have some execution cost. Okay, and the execution cost depends. You can model the fact that, for instance, you need to cross the bid-ask spread, or stuff like this. Or if you want to trade a lot, you will have a convex cost, strictly convex. So you can add, basically, it's an encounter between Haviland and Stoikov on one side and Amgren and Chris on the other side. And now, once you have all these ingredients, you can take the same objective function as before and see what happens. But before I do that, let's talk about the tiers. We did an experience here to see how we can tier clients based on how they trade with.
Sorry.
Yes.
So you model externalization as if the dealer is actually absorbing all the order flow, then offloading with the blue term, right?
What do you mean by absorbing all the order flow?
Well, I thought externalization means you don't actually do all the trades with the client order flow, but you redirect it to.
Oh no, I don't redirect it. I do. I can still.
You do all the trades.
I do all the trade, but by all the trade, I can still control, because I control the delta. I can still attract buyers or deter buyers, but it's not something I do back to back. If this is what you have in mind, yeah, it's not back to back. It's something I trade with clients, and then if I'm too long, I will try to go on another platform to sell.
Yeah, but well, here you don't have inventory constraints, but if you do, it makes a big difference. Right? If I can match orders.
I don't have inventory constraint, but I have an inventory penalty.
Yeah, but that changes, right? Because if you do back to back, you don't charge the QT.
True. Yeah. Here,
I can do huge volume of externalization while maintaining my inventory cost.
Interesting. Yeah. Here you can.
So Q will include all the.
Yes. So I was talking a bit about tiering, and so here you see we took one of the authors of three of the papers.
There was a question there.
Oh, there was a question there. Sorry.
Just a small question.
I'm sorry. I looked there, and the questions are there.
So regarding the externalization term, so what you assume there, is it that just crossing the spread, or does it also include cases like we just place like a passive order?
It's like an Amgren increase in the sense that the execution cost function summarizes your behavior. Okay, it means that if you manage with your strategy with passive and aggressive orders to if you manage to pay on average, say, 2/3 of the bid-ask spread, then you can put that into that. And it's not only crossing the bid-ask spread, but it can also be something convex, saying if you want to trade too much, that's going to be costly, very costly. Yeah?
Are you making any assumption between the liquidation cost, any correlation assumption between your liquidation cost and the price of the underlying itself?
Here, I haven't discussed this, but here it's something very important. When I externalize, I send a signal to the market in some sense. Otherwise, the market doesn't know it. It's not true. But otherwise, the market, if I'm only internalizing, the market doesn't see anything. Not completely true, because I usually skew my quotes. The market can look at my quotes, and based on the skew, say, okay, this guy is long, so maybe somebody sold and the inventory is there. Okay, but here we assume that there is some information leakage or market impact. Okay, it's the first term. Thank you, because I forgot to discuss it. That was another question.
But one reason you externalize is because of inventory constraints, but this would not appear here.
It's because of inventory cost. It's because of inventory penalty here, the reason why I externalize. But it's not like a hard, it's like instead of having a hard constraint, I have a soft constraint. And you can put, if you want to say, I have a limit, or you can say something like qt minus the limit plus square and put a high coefficient in front of it. So instead of having a hard cut, you have some, you soften it a bit, but
yeah, well, but it's very different. You have an integral, so at any point in time, it doesn't matter.
True.
So, okay.
Yeah, true. It's a running cost. True.
So typically, if I have a lot of skewed order flow, I would externalize the imbalance.
Yes.
That's very intuitive.
Yeah, that's intuitive.
So if you put an inventory constraint, that will happen.
Yes.
But here, I'm not sure.
Or here it will happen. Yeah, of course. So regarding tiers, we calibrated some logistic functions to some data provided by HSBC, and we found out that there are two clusters of clients. Some are price sensitive and some less price sensitive. So it's just to show you an example with two tiers. Of course, in practice, the tiers are based also on commercial relationship, I think, and I mean business relationship. There are plenty of reasons to tier people based on like the information in their flow. There are plenty of reasons. It's just to say here there are two tiers and that's it. You can write the equation. So instead of having a system of ODEs, you have a partial integral differential equation. But still, the theory is the same, and you can write the optimal control. So here now the control is the price you propose at the bid, the price you propose at the ask, and also the speed at which you externalize. Okay, and of course, it's kind of obvious, but you will sell when you're long, and you will buy when you're short. Okay, but the speed is interesting. So here it's the result. So we have to concentrate a bit on this. So there are two tiers. Tier 1, not that price sensitive. Here is the price we propose for 1 million, 2 million, 5 million, 10 million, and 20 million, something like this. Okay, on the bid side. Okay, depending on the inventory. Of course, when we are long, we propose a price that is low because we don't want to buy again and again. Okay, and symmetrically here, when we are short, okay, we want to buy, so we want to attract sellers, and so we propose a very good price. Okay, that's the zero is basically the reference price, and that's for tier 1. It's symmetric for the ask, so we did not put it. We put the one for tier 2, and you see for tier 2 we propose better prices because they are more price sensitive in that case, just to show the difference. But what is interesting here is when we put a spread term, there is an area which we call the pure flow internalization. It's not a real concept, but it's just to say, if we are under this inventory and this inventory, we don't externalize. And we only externalize when there is a threshold of inventory. And it's really linked to the fact that the function L contains a term which is linear in V. Okay, if you take something quadratic, you don't get it. But if you take something like a spread, like a fixed cost to trade, okay, so fixed per unit, I mean, psi of absolute value of V. In that case, you get this this area, which says basically here when you're long, you're going to sell because V is negative. It's here, and when you're short.
Sorry. So you're saying without putting an explicit threshold on inventory,
yes,
you get this
yes, and it's linked to the value of the bid-ask spread. Okay.
This has nothing to do with your performance criteria, because if your gamma is very high.
No. Well, of course, it depends on the gamma.
You're low enough for that, but I think for any gamma, mu will try and be positive, or you have to constrain the.
I think you always have an area like this, okay? I think, but the thing is,
I would have thought that mu is always switched on. I don't think that the solution will tell you not to do anything, Algorithmic Chris type. I think it will always tell you to do something so long as Q is different from 0.
So that's because they have a transaction.
That's because of the, it's not a V square like in Algorithmic Chris, but it's a psi absolute value of V plus something V square. It's linked to this spread term in some sense.
It's like in the Leyland.
In the what? Leyland. Yeah, it's like in Leyland. So you have this. So I think it's quite interesting. And of course, as you said, Alvaro, if you are really risk averse, then of course that's going to shrink, and you're going to say, "Ooh, I'm too long. Let's unwind executing on the market. Let's execute on the market." It's interesting because it's exactly this. When you increase this way, when you increase the risk aversion, you see that you almost trade the same amount with the. We did the Monte Carlo here. I don't give full details, but you trade a lot, and you trade the same amount approximately with the people that are not that price sensitive. But when you increase risk aversion, okay, you decrease the volume you trade with the people that are price sensitive because you don't make a lot of money out of them. Okay, so when you take a position, you make less money, so you don't want to trade with them, and instead you are, so it's the same color code than here. Huh? Instead, orange, you hedge, as they say. So it means you externalize the flow. Okay. You don't externalize the flow. I understand you don't externalize your flow, but you externalize. You go see somewhere else if somebody can take a bit of your inventory, not your flow. You're right.
Yeah, but I think normally you do take it in your quotes and you immediately unwind. Bear in mind that you stream quotes to clients who you honor the quotes, they trade on your quote, and then you decide to unwind. So it does go into your quotes before you decide to go elsewhere. It's not that I want to buy from you and you say, hold on, only if you can get rid of it will you trade with me. No, it goes into your books and then you decide.
In FX, for sure, there is no back-to-back on the phone. You don't wait for some. Yeah, on other, like maybe on corporate bonds, you can say, wait a minute, maybe I have somebody else. Yeah, like the two-phone guy.
For dealers, but you have single dealer trading platforms which do that. They match.
They match. And more, but this is why I say in corporate bonds a few years ago, I read some reviews of the market saying there is more like back to back and like two from problem. But I have no.
They show pictures where it said like 80% of the trading was algorithmic, right? So that is not a.
Yeah, that's not a. You don't have an algorithm with two. Yeah. And here is just to show that in spite of the fact that we use a tiny approximation to compute the quotes, when we randomize the quotes around the thing, we obtain the same efficient frontier for different. This is for different gammas, okay. And basically, we managed to have an efficient. That's for one currency, and of course, in practice, if you talk with an FX market maker, an FX dealer, they don't care about trading USD EUR. They care about having like being a one-stop shop and like proposing quotes on everything, even on things where you cannot hedge. Like I don't know, maybe there is no market for
Zimbabwe.
Well, Zimbabwe, yeah. And a lot of digits. But there are pairs for which, of course, you want to propose as a dealer, you want to propose some bid and ask quotes, but you can't hedge. But still, you can hedge with US dollars. Okay? So there is an interest for having multi-currency. So here, we took a problem. There is no math problem here. It's just a question of modeling, and it's not obvious. There are some tricks. If you try to do it, you're stuck, and at some point, there is a point where you say, okay, that's the way to proceed to have a model. So you have D-stochastic D currencies. So you need to have first one currency which is here for accounting. So you can choose USD, okay, or EUR if you prefer, or GBP if you like GBP. Nobody does that, but USD or EUR. Let's say USD, and I will assume there are D tiers of clients. And the thing is, I don't want to enter into full details, but the thing is to have a model that works. So to have the equation that to have good equations, I will assume that even if I trade I don't know, CHF SEK, okay, so Swiss franc against Swedish crown, okay, I will assume that the sizes are constant in USD. It's just people send an order, and I will assume that from one at any time they will say 1 million, 2 million, or 5 million, okay, but in US dollar. Of course, there is a tiny change in practice, but it's just a modeling assumption. And I will assume also that the deltas that I have, or here I assume they are in bips, so multiplicative, which I think is a better assumption than what we did before. And I will assume that they are converted instantaneously to USD. Okay, it's weird, but it's just, otherwise the equations are completely messy. Okay, and if you simply do these two things, okay, you manage to write everything in USD in a nice way.
Yeah, but in practice, you don't trade the crosses as you trade through the main currency.
Oh, true. No.
Why do you need all pairs?
Because in practice, the dealers, they want to propose a price for CHF SEK.
Really?
Yeah.
I'm not sure they do. Don't they do CHF Euro SEK?
Well, maybe that's not my example is wrong, but clearly they don't only trade with USD.
Yeah, exactly. Yeah, the euro would be in between.
Yeah, for the example, CHF SEK euro would be in between, but clearly not USD. That's the point. Clearly not USD, and you can propose some other stuff, but USD is not all the time in the pairs. You can propose with
Everything equates to USD. So
yes, but USD so is my currency for doing accountancy or whatever. Yeah, but still, I want to propose some quotes on pairs that do not include USD. That's the point. Maybe SEK, CHF is not the right example, but that's the idea. And I will assume that on all currency pairs, there is a market. It's not true at all, but I will explain why it's a good assumption anyway. On any currency pair, there is a market where I can unwind my position up to a cost. If the market doesn't exist, I put the cost to something very high, and of course there will be no trading. Okay, if the bid-ask spread is infinite, there is no market. But still, I assume that I can trade any currency pair and one on each currency pair. And this is the term that was before to guarantee that there is an area, a zone where I don't unwind my position. So, well, don't focus on the equation. They are of course boring and cumbersome. Okay, question.
Why there is an assumption for I smaller than J?
Because here Xi is sign. You can buy or sell. So it means that I only need half of the matrix of the matrix.
Yeah, but then you have triangle arbitrage.
True.
Restriction. So there are too many things.
There are too many things, but still there is a market.
So just need D variable, not D squared over 2.
But because of the execution cost, I will pay more. So it's not. I don't create arbitrage in some sense. You know, it's there is always a bid-ask spread. So the arbitrage, the triangles are only theoretical. In practice, it's you don't. I mean, you need to have something like this to really have arbitrages. Here, I don't create arbitrages. That I'm sure, because otherwise I would have a crazy.
Where's the restrictions?
No, there is no restriction. I just say that there could be, but the thing is, no. Sorry, there is none, because here there are only D prices, huh? And the mid price for a pair that does not involve USD is of course the ratio between the two. No, of course. It's just here I can trade anything, any currency pair. And in practice, if there is no market for SEK-CHF, then I just put a psi to like something super high, and of course nobody will trade on this. That's the idea. You look at the equation. Of course, we also put some market impact of our trading. I don't want to focus much on this, but the idea is you get a multi-currency objective function, okay, which is almost the same as before, except that the right variable is the variable converted into dollar. It's not your inventory, it's something converted into dollar, okay? You end up with something crazy in terms of Hamilton-Jacobi-Bellman equation, okay? And theoretically, you can prove that there are optimal quotes, okay? I don't want to like, I just want to show you that there are equations, but of course, I don't want you to read this, okay? The thing is, if you think about it, what is the number of the dimension of that stuff? If you look at here, the value function depends on t, the time, and y is basically my inventory. So it's a vector dimension d. It's my inventory in dollar of each currency. So it's in dimension d. If I want to have 20 currencies, I have a problem in dimension 20. Of course, I can't solve an AGB equation on a grid in dimension 20, so I'm stuck. I can say there is a simple structure on the correlation. Maybe I can use some factor methods. That doesn't work really well. We can use reinforcement learning, but it's slow and quite dangerous sometimes. Here we use something which we like created in some sense in another paper. It's to say, okay, we have a huge equation here, but if the h function here and the h function here is quadratic, then trust me, there is an explicit solution. So the thing is, let's take h quadratic by taking a quadratic approximation of the h. It's slightly more complicated than this because h is decreasing, but usually there is this h of p and h of minus p. So overall, you take the even part of the function and things are U-shaped. So replacing them by parabola is an approximation, but I mean, you have to do something if you want to go to dimension 20. So this is what we do. It's called BEGV trick because it's Bergo, Evangelista, myself, and Vieira. It's something we did in another paper. And basically, so the idea is if you replace h functions by quadratic functions, okay, so it's just a Taylor expansion, then we have value functions that are polynomial of degree 2 in y, so a polynomial in dimension d, okay, but of degree 2, and the coefficients they solve Riccati equations. Riccati equations are ODEs, paradise, compared to PDEs, and so we can solve that. We tried in low dimensions, so when you have only a few currencies, we could do PDEs and this, and it works really well, except in one case, if there is a lot of flow asymmetry. It means if there are a lot of buyers and only a few sellers, then the approximations are not that good. But otherwise, surprisingly very good. Okay. Here, for instance, it's an example with three currencies. So you have a full triangle. Okay. So you have I mean, Euro USD, cable, Euro GBP. You have everything, and I mean, I don't want to spend time analyzing this, but basically it means that what you see is that, of course, when you have long GBP inventory, well, you don't want to attract people to buy even more GBP, okay? And even there is even an influence on the EUR USD pair because there is a correlation structure between the three stuff. Okay. Here is another example where I think we took 5. 4 plus 1 USD is, of course, not risky in that case. Where we looked at the hedging strategy, the optimal externalization strategy, and we always see this area where we don't externalize. Interestingly, here we looked at the density of the inventory, so two-dimension density of the inventory, and so when we play the strategy, we do a Monte Carlo, and we see that it's really aligned with the ellipsis that corresponds to the correlation we inputted, okay, into the equation. So really, it manages the risk in line with the risk. It manages the risk in line with the risk we inputted. Just to show you a short animation before I go to crypto, it's just an example of the strategy. Just to show you, okay. So here we have the three currencies, okay, and here it's what do you say, blinking. So you have the trading on one pair, then on the next, then on the next. Here you see the different streams that I propose, and of course the skew depends on my inventory, whether I'm long euro and long GBP, or short euro and short GBP. And when you look, of course, I won't spend time on this, but it's consistent. And here you see, every time you have a huge trade, with a client, not every time, but sometimes when you have a huge trade with a client, you start hedging a bit, okay, so externalizing the flow with tiny transactions, okay. So it's really something we exemplified with like on say 3, 5, and then we started something with 20 currencies. But yes.
In your modeling of externalize, does it also have anything for our own market impact?
Our own market impact.
Like if we the market impact of our externalization.
Yes. In the 1D case, yes, and in the multi-currency, yes. Every time we trade, we impact the price with respect to dollar. So it means that if we trade a currency where there is no dollar in it, we have the same market impact as if we did the trade through USD, to be consistent. But yes, there is this. The things that are not in the model are adverse selection, so important in the case of market making. So this is not in the model, and also or informed trading, but that you can tier people and say, this guy, look, when I trade with him, is some flow that are not really normal. Okay, and also there is not another idea. Sometimes I have questions about this. My quotes, okay, tell something. If I skew, it tells something about my position. So even though I did not trade on the market, so I didn't send orders, okay, people see that I'm long in some sense. So if you take that into account, then you will skew a little bit less to give less information. But there are a few missing stuff, of course, in that case. So that was for FX. And now I want to speak, I have still 10 minutes. I want to speak a bit about cryptocurrencies. Just to say, I'm not a crypto guy. I was not really interested in crypto at first. I have never bought a Bitcoin, okay? So I was not hooked on it. But in 2021, 3 days before Christmas, so I guess the guy was bored, he didn't know what to do. I received an email from somebody called David Buba, who co-founded an AMM, an automated market maker called Swap. Maybe you know Uniswap. So it's another AMM. And quite interesting, he sent me a white paper, interesting remark, and an invitation to discuss with him. And less than a year later, we released the paper that I'm presenting here, okay? And I want to give you some ideas about what it is. Basically, really cross-learning between traditional finance and decentralized finance. So just an introduction. We all know the different mechanisms to trade or to take liquidity. You have limit orders, auctions, dark pools, request for quotes, request for stream. But AMM is something different. It's a mechanism by which traders can swap one asset against another using a pool of reserves posted by other agents that we call liquidity providers. So you have liquidity providers, they supply reserves to the pool, and you have liquidity takers, they use the AMM to trade using the available liquidity. And the exchange rate is based on a predefined and public rule, okay? That depends on the setup of the AMM, okay? And depends on the transaction size and on the direction of the swap. These AMM, they differ from dealer markets because anybody can provide liquidity. They differ from order-driven market because when you send a limit order, you send a limit order with a price. Here, the price is determined by a formula of the AMM. They differ from dark pool because you see the liquidity. There is pre-trade transparency in some sense. So it's really different. Another difference is that they are fully collateralized, but that has nothing to do with what I will talk about. Classical AMMs are CFMMs. They are the most popular ones. And the idea is, well, you have, say, you want to do Bitcoin against USDC. And basically, you want a given formula to remain constant. Usually, I don't know if I write it here, but usually it can be the product. Okay, that's a CPMM. You want that constant to remain, you want that formula to remain constant across trades. Okay, so if there is a trade with the platform buying delta Q1 and swapping this delta Q1 against delta Q0, I want this, so after the trade, to be equal to this before the trade. Okay? Similarly, it's the implicit function theorem. If f is well defined, has some properties, natural properties, then it means that Qt0 is always a function of, is always determined by a function of Qt1. The two currencies are 0 and 1. In practice, there are transaction costs, so it slightly modifies the formula, but that's the idea. And the most common CFMMs are constant product market makers, in which the function f is the product of the two. So you are basically on hyperbolas. Q1 is equal to, or Q0 is equal to a constant divided by Q1. Okay? If you look at what happens here, so I take the equation that I wrote before here, but in this form, and I say whenever a client wants to sell delta, so an LT wants to sell delta Q1 coins, that client will receive delta Q0 of currency 0, and I want this to be verified, but Qt0 was psi of Qt1, and so the price is the ratio between the two stuff, and it's like this. Symmetrically, it's the same, and if I pass to the limit for infinitesimal trades, it means that the mid price, the exchange rate, it should not differ from minus the derivative of the function psi, just because here you have finite differences and you pass to the limit. Okay? If you look at what happens for the payoff of liquidity providers, it's a bit technical in terms of math, but it's just a Legendre transform. You look at the P&L of LPs and the P&L of people that would have stayed outside of the pool. We call that the Hodel strategy, the buy and hold strategy. Okay, and because psi, or usually psi is convex and psi star is in any case convex, you see that this the difference between the P&L and the P&L of staying outside of the pool is negative. So you can say, but why do people provide liquidity to that? That's also a question I have in some sense, but here it's because the story is incomplete. There are some transaction costs. Okay, they are exposed to a negative payoff, which look like an option. Okay, payoff. So contingent claim in some sense, but to compensate, they have some transaction costs. So if there is a lot of flow, it's fine. If there is not a lot of flow, it's not fine. And if the market, if the price deviates a lot, it's not fine at all. Okay, so this is the idea. Because of this impermanent loss, the loss that we have here, Uniswap v3, they propose to reduce the risk faced by LPs by concentrating liquidity in an interval of price. It means that you decide, if you want to know more, there is a nice paper by Alvaro and the three of them. Yeah, the last row of the room.
That's why we're here.
Yeah. You can you can decide to post liquidity, but only over a range of price. If suddenly the price get out of that range, okay, and in that case the option would be very negative. Then basically you don't post liquidity. Your liquidity disappears. Okay. Here we explore a different mechanism. Okay, in which the pricing function uses some information from another trading venue, like we do in OTC trading. We import some reference price, as I said before. So basically, I want to import the IDs from FX or from any market making in traditional finance to DeFi here, but there are some differences. Okay, and I will propose some invariance framework. I will explain. I will go fast because I have 5 minutes remaining. The idea is I will do exactly the same thing as in the previous model with FX. So I will decide that there is one currency that I use for accounting between the two things. And basically, as before, the markup, I convert them into currency zero. In practice, it doesn't work this way, but you can, I can explain a mechanism by which it's almost equivalent. And so that's an example. So if a client wants to sell Z coins of currency 0 at time t, then he will receive Z divided by S coins of currency 1, okay? And he will basically pay a bit, okay, as a markup, okay? It's just in the model. You can assume it's in currency 0 and currency 1 is just, I assume that everything is in the accounting currency because the equations are simple in that case. So I do everything as I did before for market making, but there is one difference, okay, which is that I don't care about the return. I care about the difference between the P&L of the LP and the P&L of somebody outside of the pool, because the assets are risky, okay? The position is not zero. For some reason, people have Bitcoins, and they decide to put them in the pool or not to put them in the pool. I don't want to discuss the reason why they have Bitcoins. Okay, they have Bitcoins. They can decide to put them in the pool or not in the pool. Okay, so it's like there is a benchmark. So instead of having volatility, I have some tracking error. It's really you benchmark everything, and you want to see what happens to the model when you benchmark to the other strategy. So we build a market simulator to see what happened, and we solved. I will go fast, and we solved the Hamilton-Jacobi equation. But here, I'll skip that. We built the Hamilton-Jacobi equation. We did a tiny approximation to remove some of the variables to be able to compute the value function. And what we built, I want to go to this graph. What we built is basically a simulator in which you see here what happens. So I know my simulator knows exactly the price. It's not true in practice. There are oracles, but here it's with a perfect oracle of the price. And I will assume, for instance, that I always quote at say 2 bips, 6 bips, 10 bips, 14 bips, 18 bips from the mid price. Of course, nobody can trade at the mid price. There is just a demand function for some Bitcoin at a distance from the mid price. And here is what the best I can do using my optimal strategy. And here it's what Uniswap and Balancer and Curve are doing. And here it's the standard deviation of the excess P&L. Excess means compared to biennial strategy. And here it's the mean of the excess P&L. So it's like in Markowitz when you benchmark, okay? And you see here that the things that do exist today are not that good, okay? And here it's far better. But of course, I assume that I know the price, okay? So it's really far from DeFi in some sense. So I need to study what happens when I don't know the price or when there are misspecification. When there are misspecification with respect to the trading flow, it's just that I'm basically doing a tiny promenade on the efficient curve. It's not really interesting. Same thing for if I'm wrong on the volatility of the pair, well, same thing. I stay almost on the efficient frontier, and that's it. For mu, if mu is misspecified, I think here it's only for half a day, so we don't really see a difference, but that's not really interesting. What is interesting is what happens with oracles. Okay, so before I assumed that the market exchange rates, the reference price in market making model was known at all time. In practice, I only have an idea of that. Okay, it can be noisy, it can be lagged. There are many problems. Okay, so it's only at discrete time, and I said that. So here, what happens is that I will play my strategy, okay, for different risk aversion, different values of the risk aversion, but with a lag. Okay, so I will assume that I have perfect information, that's the efficient curve, or I have a 10-second delay in the price, or a 30-second delay, or a 1-minute delay, or something you can see, but it basically says here that it's more, and you see that basically if we are at even a 30-second delay or even 1-minute delay is okay, and it's far better than what Uniswap does. So the morality, if I can say so, is that importing information from outside increases the risk profile and the performance of the dealers, of the liquidity providers. That's an interesting error. So it increases the risk profile in the plan here.
How do you see this in your picture? What's being compared?
If you remember, well, the Uniswap, it's basically because you have to have this in mind. Here, all these things, they were in the negative territory of the mean. Okay, you lose money on average. Okay, if you are a liquidity provider inside a CPMM, basically.
This assumes you're not hedging out.
Yes.
If you hedge it out, then
yeah,
because you're basically just short an option, right? You're short gamma. So if you're hedging,
yes, it does not incorporate this, but you have to be sophisticated, and most of the people, when they post, they don't. But true, I mean, you short gamma. You need to hedge your position. But I mean, then if you think of a mean field problem, if you think of equilibrium, I mean, at some point, where do you hedge? So here you see that you enter the negative territory of mean only when basically you have 5-minute delay on this example. But if you have 10-second delay, 30-second delay, it's fine. Okay? So importing information from an oracle is better than importing information from arbitrageurs, because at some point, arbitrageurs, they are just giving you information about where the price is, and you lose money out of arbitrageurs. So basically, it's a bit better. We also added some arbitrageurs, okay, systematic arbitrageurs in that case, and that did not change much. For some reason I can explain, because basically when in the demand curve we are, which is logistic, it's like there is already some arbitrage, okay, some arbitrageurs. If you really price something that is completely off compared to the market, you will have people coming anyway. It's not systematic, it's probabilistic, but you still have this. And here it's an example, like with everything. Okay, here you have the classical Uniswap V2. So without CL, without concentrated liquidity. Here you have the frontier. Okay, with arbitrageurs. Okay, and I think perfect oracle, but we have seen that even if when the oracle is not perfect, it's far better than all these guys here. Okay, so the main result is that traditional CFM perform poorly relative to the efficient frontier, and very often exhibit negative excess P&L. I don't know the statistics. I know you guys, you know the statistics on Uniswap V2, and if I remember well, in practice, LPs were losing money, like 90% of the LPs were losing money. but they want to be part. They want to be in the boat. They want to be part of the story. So they don't care about losing a bit of money, maybe. The point is, allowing an AMM to get information about the current market exchange rate through an oracle can significantly improve the performance. It reduces the volatility of the excess P&L and allows to deliver a positive excess P&L. Another answer could be forget that and hedge a bit. Okay.
Sorry, just on that, the second point, if maybe I'm misunderstanding it, but on the automated market maker, he's updating it far more than the traditional, correct? Or
what do you mean by updating?
Well, because he's getting more information. Because allowing the automated market.
Oh, you mean the price changes far more?
Exactly. So
yeah.
So is he not updating his what he's sending into the LP far more than if he'd just been a traditional?
Well, for sure.
So then does that not result in a cost in terms of gas fees?
Depends whether you do that on chain or off chain.
Okay.
It depends. But still, the philosophy is that the code is public. Yeah, it raises a lot of information about the philosophy of DeFi. I agree with you. And the general conclusion is, well, market-making models are important for OTC markets because of automation. There are still many effects that need to be modeled. I talk about adverse selection, information leakage about the skew. You can have other IDs. There are still a lot of stuff to do. For example, also, I talk about the mid prices, the reference prices. Clearly, inventing your own reference price that is relevant is a statistical problem, a filtering problem that is interesting. So estimating the flow, the probability of people trading with you is something quite important. And research on AMM is very active. There are people at Berkeley. There are people at OMI. And there are, I think the topic is interesting even beyond cryptos. Of course, the assets must be digital to be on this, but it's really a new way, a new trading mechanism in some sense. And I think it's interesting to study. And I know there are a lot of problems. There are a lot of people working on different problems in this. So you already asked questions, but I'm still very open to questions and discussions.
Thank you very much. Any questions?
Yeah, so how is the market mechanism adapted into your SJP equation for the crypto?
The difference between the AJB equation between FX and crypto?
Yeah.
It's basically
for example, the constant function C is it included in your SJP?
Constant function. Well, there is no externalization, if that's your question.
Yeah, no, I mean the market mechanism, for example, the constant function market makers, there is a function C. I wonder if this is
Here I want to say, okay, what is the best quote I can provide? I don't want to optimize to find the best psi. It's not the topic. I have an oracle. I wasn't clear. I wanted to spend more time on this, but so there is the oracle I have, and it's like a reference price in traditional markets. And I want to say I will propose a price at the bid and a price at the ask, as a like based on this stuff. There is no more. It's not a CPMM, the AMM we have here. It's clearly not a CPMM because I don't want to be exposed to the. I don't want to be exposed to the option.
So you compare this to the CPMM at the end.
Yes, that's the idea. I was fast. I wanted to cover maybe too many stuff.
Other questions?
Sorry, non-technical question, but the guy who messaged you regarding this automated one,
yeah,
have you proposed that idea to him then? Or
well, of course they are implementing this.
okay.
Yeah.
When is the ETA? When do they expect it to?
I think it's. I think the version is in production.
Okay.
but they did something based on this. I don't know exactly what they did.
Yeah.
But so it's a French company. I think this month they raised a little bit less than 5 million USD, which, I mean, I think given the current market conditions is not that bad.
Other questions?
Yeah, maybe one thing. So, one question. So, in this framework, you're basically like,
Louder.
In this framework, you're basically like framing this problem as it was like an FX problem. So yeah, so you don't have like CPMMs and AMMs anymore. So my question would be, so you would have to compare this market to Binance, for example, to a limit order book-based market. What are the advantages of trading here compared to trading to a proper limit order book market?
What do you mean by comparing?
So why would I trade here instead of trading on Binance?
But I'm more interested in the P&L of LPs. So the thing is, I'm interested in the P&L of LPs, and I'm comparing the different platforms, so CPMMs or CFMMs in general, and this kind of framework with just an oracle. I'm comparing them from the point of view of LPs, assuming that there is no, because in fact the real problem is super complicated, because you need to I mean, you know that, but you have LPs, but you need to anticipate the number of LPs that will be there in the future, because the money you will make depend on the number of LPs that are with you. It's quite messy.
You know, because the market in Binance can be framed in the same way.
Market in
limit order book markets like Binance can be framed from the liquidity provider perspective in the same way.
So yeah, I understand what you mean. It's because given the size of the tick size on Binance, which is quite small, yes, you can say, but this is my point of view here is that the LPs are just investors, like investing in a given market making strategy. Does that make sense to you? Yeah.
Yeah, and also I have another question. So when you define your state variables,
yeah.
So you assume that your y and your x are like the value at time t minus the value at time 0. So this is
because I'm compared to Odell.
Yeah. Yes. And what I'm saying then is like if you use like your y as like a risky asset, you assume that when y is equal to 0, then you're risk neutral.
Why? I have no risk, you mean? Yeah, I must assume, well, your point is I must have one currency, which is the accounting currency. And it's true that if I take a pool, which is, say, ETH versus BTC, Ether between BTC, if I assume that BTC is the accounting currency, or if I assume that ETH is the accounting currency, I don't get exactly the same result.
No, my question was more like if your y is equal to 0 here,
yeah,
it doesn't really mean that you're inventorying the y is equal to 0.
No, it means that my position is exactly the same as if I did buy and hold. It's really the position. The position is really the position compared to the buy and hold strategy, which is what you do when you compare to Odell. The problem is that there are other paper in which you hedge, and in that case, it's not a. You can say Odell is not the right benchmark. Yeah. This is basically your opinion, I guess. Yeah.
Okay. So thank you very much for your talk and discussion.
Thank you.